In 2006, Chile's Congress passed a law that removed itself from the spending equation. Article 3 of the Fiscal Responsibility Law mandated that all copper revenues generated above a calculated long-run reference price be transferred automatically into sovereign funds sitting outside the annual budget process. Congress could not appropriate them. The executive could not reallocate them. The rule was not a guideline. It was a legal architecture designed to make discretion structurally impossible. Before that architecture existed, Chile behaved exactly as the resource curse model predicts. Between 1998 and 2002, the London Metal Exchange copper price collapsed from approximately $1.10 per pound to below 70 cents per pound. The fiscal consequences were direct and immediate. Codelco, the state copper company, contributed between 5 and 15% of total government revenues depending on the price cycle. When prices fell, the Treasury bled. Emergency spending cuts followed. The political pressure on the finance ministry moved in precise correlation with the LME ticker. Chile's fiscal balance swung from surplus to deficit inside a single commodity cycle. This was not mismanagement. It was the predictable output of a sovereign financial system with no buffer between spot price volatility and public expenditure. Copper represented roughly 35 to 40% of Chilean export earnings entering the 2000s. That single concentration ratio made every budget negotiation a commodity bet. The structural problem was not corruption or institutional weakness. It was the absence of a legal separator between what the market was paying for copper on a given Tuesday and what the Chilean state was permitted to spend that fiscal year. Finance Minister Nicolas Eyzaguirre and his technical team inside the Lagos administration engineered the solution. The mechanism had two components. First, a structural surplus target of 1% of GDP, meaning the government was required to run a surplus, not balance books, but a deliberate positive gap between revenues and expenditures when measured against long-run price assumptions. Second, a two-fund structure to receive the overflow, the Economic and Social Stabilization Fund, known by its Spanish initialism FEEs, and the Pension Reserve Fund, the PRF. Each fund had a defined function. The FEEs was the counter-cyclical buffer. The PRF was the long-term liability hedge against Chile's demographic trajectory. The critical mechanism inside the critical mechanism was the reference price panel, an independent committee of economic experts, appointed, not elected, and insulated from the congressional budget cycle, calculates a long-run reference price for copper. This is not a forecast. It is a 10-year rolling estimate of what copper should sustainably cost, stripped of cyclical speculation. When the spot price on the LME exceeds the reference price, the excess revenue does not enter the budget. It routes automatically into the FEs. When the spot price falls below the reference price, the government is permitted to draw from the FEs to maintain expenditure. The political variable is removed from the transfer mechanism. No minister votes on it. No congressional committee approves it. The formula executes. Why it was structurally possible to pass in 2006 matters. The commodity supercycle was accelerating. LME copper prices had moved from under 80 cents per pound in 2003 toward $2.75 per pound by early 2006 and would approach $4 by 2008. Chile was running surpluses it could politically afford to save because the underlying economy was not contracting. The political window was narrow and specific, a moment of abundance, a technocratic consensus government with institutional credibility, and a legislature that had not yet organized a coalition to capture the windfall through appropriation. The law passed because saving was not painful in 2006. The copper was arriving faster than spending coalitions could mobilize. The cascade effects were measurable and distinct. As copper sustained prices above the reference benchmark through 2006, 2007, and into 2008, Chile accumulated sovereign assets at a rate that peer economies with identical commodity exposure did not match. By late 2008, the FEEs held approximately $20 billion, roughly 12% of Chilean GDP. This was not a rounding error in sovereign finance. It was a structural position. When the global financial crisis hit in late 2008 and LME copper prices dropped from approximately $4 per pound to under $1.50 within months, Chile's response was architecturally different from every comparable emerging market. It deployed a fiscal stimulus of $4 billion in early 2009, approximately 2.8% of GDP, entirely from the FEEs. No IMF program, no sovereign debt issuance under crisis conditions, no emergency austerity to satisfy creditor requirements. The stimulus was funded by the saved excess. Standard & Poor's upgraded Chilean sovereign debt to A+ in 2010 during the sustained aftermath of a global crisis that had downgraded or destabilized sovereign ratings across Latin America. Chile's sovereign spread compressed while peers widened. The borrowing cost decoupling was not incidental. It was the second-order output of the rules architecture. When markets priced Chilean sovereign risk, they were pricing an economy with a legal buffer between commodity volatility and fiscal solvency. That buffer had a dollar amount attached to it, visible in fund balance disclosures. The risk premium fell accordingly. The third-order effect was structural. Lower sovereign spreads reduce infrastructure financing costs. Chilean development bond yields traded closer to investment-grade developed market benchmarks than to commodity-dependent emerging market peers. The rule had become a de facto credit mechanism independent of any individual copper price reading. The costs were real and structural, not incidental. Chilean public spending as a share of GDP remained suppressed through the supercycle years precisely because the rule was functioning as designed. Social expenditure on healthcare, education, and housing did not scale with the copper windfall because the windfall was legally sequestered. The 2011 student protests and the 2019 social uprising both drew structural oxygen from the same source: a visible accumulation of sovereign wealth managed in foreign fixed income instruments, while domestic public services operated under chronic underinvestment. This is not a political observation. It is an engineering trade-off stated plainly. The rule optimized for sovereign resilience and counter-cyclical capacity. It structurally deprioritized social expenditure, compounding during the accumulation phase. The fees assets were invested primarily in external fixed income instruments, U.S. Treasuries, European sovereign bonds, high-grade corporate paper. The windfall financialized outward. It did not compound inside the Chilean productive system. Codelco's own capital expenditure was simultaneously constrained, contributing to documented production decline through the 2010s. Codelco output fell from approximately 1.8 million metric tons in 2004 to approximately 1.4 million metric tons by 2019. The rule saved the revenue. It did not solve the extraction capacity problem. The current structural position requires precise description. The rule survived two administrations of opposing economic orientation, Piñera and Boric, but the structural surplus target was formally suspended during the 2020 pandemic response. Fund balances declined materially. The fees dropped from a peak of approximately $30 billion to under $10 billion by 2022 as pandemic-related withdrawals and a series of constitutionally authorized pension fund withdrawals. A separate but structurally adjacent mechanism reduced the sovereign buffer. The surplus target has been only partially reinstated. The reference price panel methodology remains technically contestable. The 10-year rolling estimate is sensitive to the window chosen and the assumptions embedded in the smoothing function. The panel, using different methodological inputs, produces a different reference price, which produces a different transfer threshold, which alters the fund accumulation rate. That methodological discretion has not been fully insulated from political pressure. Lithium introduces an untested variable. Proposals to nationalize or restructure lithium extraction under a copper-designed fiscal formula raise a direct architectural question the rule was never engineered to answer: whether a second commodity with a different price cycle, different production structure, and different global demand trajectory can be absorbed into a framework built around a single input. The formula has not been stress-tested against a two-commodity structure. The structural observation that closes this is not a recommendation. It is a diagnostic. Chile's sovereign insulation in 2008 was not a natural resource story. The copper existed before 2006 and produced no insulation. The formula that decided what to do with the copper produced the insulation. Any economy examining this mechanism faces a prerequisite that cannot be legislated into existence: a moment of fiscal abundance, a technically credible institution capable of defending a formula against political contest, and a political window short enough that the saving coalition outruns the spending coalition before the rule is locked. In Chile in 2006, all three conditions were simultaneously present. That convergence, not the copper, was the operative variable.